Welcome back to The Explainer, folks. Today, we are taking a completely objective, balanced, and highly focused look at Lendlease Global Commercial REIT. Now, if you're a potential investor or really just someone fascinated by commercial real estate dynamics, you know that looking at a single metric never tells the whole story. So our goal today is to pull back the curtain. We're going to examine the raw data directly from their recent Q3 business update to see exactly where this REIT absolutely shines and exactly where it faces some heavy headwinds.
Here is our quick roadmap for today. First, we'll meet the REIT. 2, we'll look at the anchor, which is their sponsor support. 3, we dive into the bull case and their retail strength. 4, we pivot to the bear case and their notable weaknesses. And finally, 5, management strategy. Let's jump right in.
All right, Section 1, meet the REITs. To start, we have to talk about the absolute crown jewel of the portfolio gem. This is a massive suburban retail and office hub located in Singapore, and it is operating at a literal 100% occupancy. I mean, think about the current economic climate. Finding any large-scale commercial space running entirely full is just incredibly rare. Having a $2.3 billion asset operating at absolute full capacity, that acts as a massive, super reliable anchor for the REIT's entire revenue stream.
Then we have another major Singaporean asset, PLQ Mall. The big news from the third quarter here is that the REIT actually went ahead and acquired the remaining 30% interest, giving them total 100% ownership. And why does that matter? Well, full control unlocks their ability to really execute targeted enhancements, completely optimize the tenant mix, and ultimately capture higher rental rates by 2027.
Moving on to Section 2, the anchor, strong sponsor support.
Before we get distracted by yields and metrics, we have to look at the bedrock here. Lendlease Corporation. They are no small player. They bring over 50 years of local expertise in Singapore, but crucially, they hold roughly a 21% stake in the REIT itself. When a sponsor manages a staggering 48.7 billion Australian dollars in funds and they hold a massive chunk of the REIT themselves, yeah, that proves they have serious skin in the game and a really strong alignment with long-term success.
Okay, Section 3, the bull case, focusing on retail strength.
Now, if you follow real estate, you know rental reversion is the magic metric. It tells you if new leases are being signed at higher or lower rates than the old ones. Get this, in the third quarter, this REIT pulled off a staggering 12.2% positive retail rental reversion. And jump that high, it means there is immense demand for their space. They literally have the pricing power in what is a very competitive market.
And that pricing power is heavily protected by a really diversified tenant mix, which is anchored by food and beverage at 34.3%. F&B is incredibly resilient, right, because it drives consistent daily foot traffic. This curated mix supports their really healthy WALE, or weighted average lease expiry, of 4.7 years. Basically, on average, their tenants are locked into paying rent for almost 5 more years, which guarantees a super stable income stream.
Plus, year-to-date tenant sales have just surged by 17.6% year-over-year. This was driven by a bunch of factors: new tenant additions, festive seasonality like the Lunar New Year, and some really smart, targeted in-mall activations backed by social influencers. Bottom line, when tenants are making more money, they are way more willing to accept those higher rents, which naturally keeps the REIT's retail occupancy rates near perfect.
But look, we have to stay objective here. So Section 4, the bear case, and some notable weaknesses.
We are seeing a pretty stark geographic divergence in performance. It's almost a tale of two cities. Contrast the bustling 313 at Somerset in Singapore, which provides deep stability and makes up about 90% of the portfolio's value, with the Milan office segment overseas. That Italian exposure is painting a much more challenging picture. The crucial point here is the visible gap. While that Singapore retail portfolio is practically bursting at the seams with a 99.7% occupancy rate, the Milan offices are sitting down at 89.1%. So that underperformance in Italy is acting like an anchor in a bad way, literally dragging the overall portfolio occupancy down to 95.3%. It's a very clear pocket of weakness in an otherwise tight ship.
But honestly, beyond just the physical real estate, we absolutely have to talk about the debt. To really grasp the financial pressure the REIT is under right now, we have to look at the interest coverage ratio, or ICR, as defined under the Property Funds Appendix rules. Put simply, this metric tells us how comfortably a company can actually pay the interest on its debt directly from its earnings.
And well, this is exactly where the bears start to roar. The REIT's ICR currently sits at a concerning 1.8 times. For some context, anytime an ICR dips under 2.0, it generally signals that financial breathing room is getting tight. But what's really alarming is their own sensitivity analysis.
It shows that just a mere 1% increase in interest rates would drop this ratio even further, down to 1.5 times. In today's highly volatile macro environment, that represents a very real, significant risk profile.
So what are they doing about it? Section 5, Taking Action, Management Strategy. How exactly is management navigating this really tight debt environment? Well, they aren't just sitting on their hands. They are actively pulling levers. First, they successfully refinanced existing perpetual securities with $120 million in new issuance at a pretty manageable 4.28% rate. Second, they divested the GEM office component entirely to free up some much-needed cash. And third, right after taking full ownership of PLQ Mall, they immediately refinanced its loans, which secured about $2 million in annual savings. Basically, they are fighting tooth and nail to improve that tight ICR.
They are also playing defense, protecting the bottom line from external shocks. They've smartly shielded the REIT from crazy energy price volatility by locking in fixed-rate electricity tariffs all the way out to FY 2028. This means that even if global oil prices completely spike, the operational costs for running these massive malls remain totally predictable and stable.
And that brings us to the ultimate question for you as an investor. You have to weigh two completely competing realities. On one hand, you have the undeniable strength of the Singapore retail assets, driving huge foot traffic and delivering double-digit rental reversions. But on the other hand, you have heavy macroeconomic debt headwinds, perfectly highlighted by that tight 1.8 times interest coverage ratio. So, does the underlying property strength give management the runway they need to finally fix the balance sheet? It's a truly fascinating standoff. Thanks for joining me on this explainer, and remember, keep asking the hard questions.